Good afternoon, everyone. Welcome to the JKH Investor Relations Webinar for the fourth quarter and the financial year ended 31st March 2025. I am Gihan Kure. I'm the Deputy Chairperson and Group Finance Director. I'm joined today by our Chairperson, CEO Krishant Balendra. And the format for today's proceedings is where Krishant will initially take you through a macro overview and some of the key highlights for our performance for the year and some of our key projects. And then thereafter, I will take you through the financial performance and some of the key highlights for the year as well as the quarter. If you have any questions, please insert them into the Q&A tab that's at the bottom of your screens. With that, I'd like to kick things off by asking Krishant to give an overview. Thank you.
Good afternoon, everyone. Thank you for joining our investor webinar. On the macro, on the political front, with the national level elections late last year, presidential and parliamentary elections, as well as the recent local government elections, the main cycle of elections is now behind us. We have continued to see political stability, and with the elections behind us, we expect to continue to see stability going forward. The economy has strengthened. All the indicators are positive and keep getting better. We have seen the rupee depreciated a little during the fourth quarter, but is still significantly stronger than the lows of what we saw during the crisis. Inflation is very low. In fact, we've had a few months of deflation, so a steep fall from the high inflation levels we saw a couple of years back. Interest rates are also dropping in line with inflation, and some of the other indicators like foreign exchange reserves and the fiscal deficit and the current account figures continue to get significantly better and are better than what we have seen for a very long time. The Sri Lankan government and the IMF had a staff level agreement for the latest tranche, and the IMF statement on the performance of the economy was very positive, with the IMF describing the performance actually as being remarkable. There are a number of prior actions that the Sri Lankan government has to take, one of which is an increase in electricity tariffs, and recently it was indicated that the Ceylon Electricity Board has asked for a 18%, approximate 18% tariff increase from the regulator, and we should have a decision on that quite soon. And the IMF board meeting is, and final board approval is expected towards the end of June. Consumption continues to get better, as you will see in our consumer foods and supermarkets numbers. Tourism numbers are back to or better than pre-COVID, the peak year being 2018. And the first 4 months in aggregate up to end of April, there is a slight growth over 2018. And going by the numbers in May to date, up to the 25th of May, it looks as if we will have more arrivals in May than we did in May 2018. In arrivals from India in particular is showing strong growth. Cinnamon Life, as you know, the hotel, we started operations, the Cinnamon Life Hotel started operations in October. We expect the Nua Hotel, the casino, and parts of the mall to commence operations in August. West Terminal commenced operations a few months back. Volumes are still low, but better than expected for the first couple of months of operations. And as you know, the first phase is operational. Phase 2 is expected to be operational at the end of calendar year 2026. Our new venture in new energy vehicles, BYD, has made a stronger than expected start. We will go into the details during the presentations, but a very encouraging start to that business. So I'll hand over to Gihan, and we will both be here for Q&A after.
Thank you, Krishant. And with that, I'll take you through the presentation on our financial performance for Q4 and the financial year. There's a lot to cover given that we are also covering the quarter as well as the year. So please bear with me, but we'll try to run through it and give enough adequate time for questions and answers. In terms of our performance for the quarter, we saw our headline numbers, the EBITDA growing by 14% for the quarter, from around 13.9 billion to 15.9 billion. Strong growth driven mainly by our consumer-facing businesses. So as you can see on the slide, consumer foods, retail, even financial services have all seen growth. Our property business did see growth compared with last year, which I'll take you through. Last year, of course, we did have an asset write-off in relation to our Viman development, but even if you exclude that impact, property did see an increase with the revenue recognition cycles kicking in, tries and handover, as well as Cinnamon Life Apartments, as well as Viman sales being recognized. So overall, headline numbers were up 14%, but as we will talk through this presentation, with the Cinnamon Life City of Dreams project now operational, as we saw in Q3 as well, we have the impact of the operations, the costs coming in, as well as then the depreciation and interest, which of course is not reflected in EBITDA, but it affects PBT. So we have a separate slide which I'll walk you through that, and I won't go through it every step of the way. But if you exclude CODSL, then you can see that the performance for the quarter was actually up 20% to 17 billion rupees. If you look at the quarterly movement right across the sort of 4 quarters for the year as well as against last year, you can see the total headline number at 15.9 billion is quite a strong number compared to all 4 quarters. Of course, Q4 tends to be a stronger quarter seasonally, particularly with leisure and some of the consumer business as well. But still, for all, like I said earlier, it's shown a headline growth of 14%. If you look at the exchange rate, some of our businesses that have foreign currency denominated revenue streams were slightly impacted as a result. So if you look at the average exchange rate for Q4 last year, which was at around 313, with the rupee appreciating to an average of around 296 during Q4. So that did have an impact on our leisure business as well as our transportation business. But overall, it's been a strong quarter. If you look at the recurring EBITDA for the year, overall headline EBITDA of 45.7 billion, which is a growth of 4%, with again the impact of CODSL, City of Dreams, coming in. And if you eliminate that, we had a 12% growth in EBITDA for the year. Again, overall, as you can see, strong growth driven by consumer foods at 34%, retail at 25%, as well as financial services, as well as our property business, even if you discount the impact of the asset write-off I mentioned earlier. In terms of annual recurring movement on EBITDA, we've seen the number at last year at about 43 billion, increased to 45 billion. As we did indicate last year, with the impact of CODSL opening, we did expect EBITDA to be marginally higher or around this range, but really the impact of EBITDA with the project ramping up, and it will ramp up quite fast, we will see the growth in EBITDA heading into next year. But if you look at it, X of that, you can see the trend of the EBITDA movement. I won't spend too much time on this slide, just to show you how the finance costs of the group have moved. This is less relevant now with interest rates having come off sharply. So if you look at the bottom of your screen, you'll see how interest rates from around 11.6, the rupee interest rates have now come down about 300 basis points to 8.5. That does have a benefit naturally to a lot of our businesses. But if you look at the finance costs, about half or more of our finance costs are coming from dollar-denominated foreign currency borrowings, which we'll talk a little bit about later. But you can also see that with the conversion of the HWIC convertible debenture in January, we've seen that the non-cash interest and the total interest on that debenture has fallen away. So excluding for that impact, yes, there is a slight increase in the total finance cost as we've sort of drawn down on some of our facilities to fund the balance infusions into the Cinnamon Life project. The recurring PBT for the quarter, so if you look at this slide again, the headline number shows a decline of around 39% from 11 billion for the quarter to 6.7 billion. But there again, with the COD project, you can see there's about a 4 billion impact, which I'll talk through, which comprises of the EBITDA impact as well as the depreciation and interest cost. So if you exclude that impact of a new project that's just come into being, then we show a very strong growth in group profits ex of CODSL. We've also shown you excluding the impact of the convertible debenture interest cost as well, which last year had about 870 million, whereas this year, because the debenture got converted in late January, we didn't have much interest cost throughout the quarter. So excluding that impact, still we've seen about a 57% growth in our more like with like PBD, if I call it that. A similar impact for the year. Again, the headline number is down 11% from 16.6 billion down to about 14.7. Again, a similar adjustment on COD, which is at about 8 billion impact. And if you exclude that, PBT is up about 60% to 22.3 billion. And again, adjusting for the impact of the convertible debenture, then the growth is still there at 36%. So the impact more again on a like with like basis is the recurring PBT from 18 billion to 24.7 billion. As you all know, throughout the year, we had a couple of corporate actions. One was the rights issue and the subdivision. And then we had the conversion of the convertible debenture in January. So these two corporate actions resulted in us raising 24 billion of capital through the rights issue. The subdivision didn't have an impact there, but we raised funds, and of that 24 billion, we've infused about 9 billion of that into the Cinnamon Life project. With the conversion of the final remaining outstanding debentures that were there, we had about 12.8 billion of debt that got converted, and that fell away. So if you look at the next slide, you see, this one, you see the impact of the debt numbers where from 220 billion in December, we saw debt coming off, and that was mainly as a result of the conversion. And with some cash build up, on net debt has come down marginally from December. And if you look at it, the net debt to equity is at about 28%, which is at a comfortable level. And based on the annual recurring EBITDA, it's a net debt to recurring EBITDA of around 2.5 times. And that's continued to sort of gradually come off. And that expectation as EBITDA continues to grow is that we would see that growth. I mentioned that I'll talk to you about the impact of the City of Dreams, the financials. So if you look at it for Q4, we had about a 1.2 billion impact at a EBITDA level. That's from the operation. So if you look at Q3, we had a higher EBITDA loss, which we did speak of in the last webinar. And that trend, it is reducing. Yes, Q3 did have some of the opening or launch costs as well. But as we've sort of ramped up our revenue, the events have gained more popularity and traction. Occupancy is gradually picking up. So with the impact of the ramp up, we are starting to see the negative impact on EBITDA reducing in Q4. The depreciation and amortization figure as well as interest costs are shown against Q3 to Q4. And then because we have a foreign currency loan of around $200 million, depending on the exchange movement, we do book in an exchange gain or loss. In the last quarter, we saw the rupee move from around 293 to 96. So there was a marginal depreciation. So as a result of that, there's an exchange loss. So if you look at the ultimate net impact on PBT, for the quarter is around 4 billion, which is the number I referred to earlier. And if you look at Q3, it was about 2.8 billion. That, of course, is because we had a exchange gain of 795. So really, you need to sort of almost strip out the impact of the exchange gain or loss. But on an operational run rate, it's about the 1.2 billion and about 2 billion of the depreciation and interest costs that we are seeing. As we open Nua as well as the rest of the property, the depreciation cost will increase slightly from these levels because it will also then incorporate the depreciation that will come in from those elements, but the run rate will be a little higher than this, but this is almost the totality of it. We get asked the question on understanding the maturity analysis of our group debt and the composition. So if you look at the third slide here, it sort of explains of our total group debt, around 55% of the group debt is actually denominated in foreign currency, comprising mainly of our debt in Cinnamon Life, that's around the $200 million, as well as our loan at the parent company, the IFC loan that we have, which the outstanding is around $167 million. So about 115 billion of debt in foreign currency, but approximately half of this is actually covered naturally as a conscious treasury strategy that the group has taken, because we do hold US dollar cash reserves at the parent company as well. So the net foreign exposure on exchange is limited. And of course, there's a natural hedge also in terms of the revenue generating aspects from the business, particularly the leisure side as well as transportation. If you look at the composition, I won't spend too much time on this, but we do have the refinancing of the Cinnamon Life loan around 1.5 years from now, but we'll take a call on how we look at that based on the cash generation capability, but that's expected to be well managed. We also get asked the question on CapEx and how things have sort of panned out in terms of our CapEx for the year, as well as expectations going forward. So we thought we'll just spend a minute or two giving you a deeper understanding of how the CapEx of the group has been. So if you look at it, there's project-related CapEx, which is this large component, which is around 67% of our total CapEx. So it's more one-off CapEx relating to the City of Dreams project. And excluding that, our CapEx, the balance 33 is really the 16 billion, which is more, not all of it is routine. There is expansion CapEx within that as well, but it's not the type of project CapEx that will be more one-off once the project is completed. So if you look at the main elements of this, it's supermarket expansion, some investments in our consumer foods business, as well as expansion of our distribution channel investments in our insurance business. The project CapEx itself, we have for the project, is about 33 billion, so that's the significant part of it, as I mentioned earlier. Going forward, if you look at the CapEx in the future, in the near term, these are not significant numbers, but we have CapEx relating to just the final aspects of the retail mall, as well as completion of Nua. But a lot of the CapEx has actually gone in the previous year. So in terms of CapEx, we won't have any significant numbers, but in terms of equity infusions, as you can see, we do need to fund the borrowing costs as well as the operational losses that are there. So there is still funding that will go in, and that's the purpose we raise funds through the rights issue. So there is a little further funding that's required for the project, but in terms of CapEx for CODSL, we don't expect anything significant. The rest of the CapEx will be more routine CapEx in terms of rolling out maybe between 10 to 15 supermarket outlets, as well as some strategic investments in our confectionery business, our beverages business, relating to, of course, expansion of capacity based on volume growth and so on. So it's really those two aspects that will be the more routine CapEx going forward. In terms of our ESG initiatives, I won't go through each one of these, but I think we had a lot of focus on plastic reduction as well as collection. We didn't necessarily hit our targets, but in terms of supermarkets business, we set ourselves an ambitious target of reducing our polythene and single-use packaging by 50%, but we were at around 35 to 26% on these two aspects. We also recycled around 750 metric tons of plastic through Ceylon Cold Stores Elephant House, one of their projects. And there were a host of other initiatives which I won't go through now. Moving on to our businesses, our transportation business, Krishan touched on briefly, the West Container Terminal commenced operations in Q4, and we received a mothership, which I'll show you on the next slide. So we had this large ship coming and calling at the port in the month of April, and really ramped up operations. And whilst it's in its sort of ramp up phase, we've generally managed to overcome a lot of the technical issues in terms of an automated terminal, and things have been progressing quite well. Overall, in the coming year, we expect volumes naturally to grow significantly off the low base quarter on quarter, where we expect to see that momentum accelerate quite sharply and come to a run rate that we think will help us to be cash neutral by the end of the first year, as well as if volumes accelerate the way we expect it to, and the regional and global trade dynamics also remain as is, we could even potentially be looking at breaking even on an earnings basis. The full terminal is expected to be operational in the second half of 26-27, where we'll then have the entirety of the 3.2 million TEUs coming into play. So if you look at our quarter in transportation, we had SAGT volumes grow around 9%, a strong growth in volumes to around 500,000 compared to 460,000. With the economy doing well, we see an improvement in the domestic mix as well. And overall, we saw translation to profit in dollar terms, though because of the appreciation of the rupee in rupee terms, profitability at SAGT was flat. In the bunkering business, we saw 17% decline in volumes, but that's because if you look at Q4 last year, we had a 50% growth in volumes because of the Red Sea crisis. And as a result, it's more of a normalizing from that peak. We did see margins improve as well, but as a result of the volume growth, we did see a decline in the bunkering business, which is why the transportation business for the quarter did see a slight decline. If you look at the year, I won't spend too much time on the annual slides, but you see overall volumes at SAGT did see growth. And if you look at the mix as well, it's heading in the right direction. So overall, both the port and bunkering business, the outlook still does look positive. Moving on to our consumer foods business, strong double-digit growth across confectionery beverages, that's our CSD business, and convenience foods. So with 12% growth in confectionery, our ice creams business, and 16% growth in our carbonated soft drinks. Overall, with that volume growth, we saw EBITDA growing by around 7%, with recurring margins at around 20% for the quarter, which is an increase Q on Q. If you look at Q3 with the type of volume growth, Q4 does tend to be a strong quarter, so that seasonal sales typically does enable you to have a better margin because of the absolute volumes. If you compare it against last year, we did see a slight decline in the EBITDA margin, but that's because we had a slight decline in the impulse, the mix. So if you look at last year, Q4, we had 39% contribution from impulse, whereas that's come to 36 in this quarter, and impulse typically has a higher GP margin. So that did affect the margin slightly, as well as we did have some higher A&P spend and distribution costs, which did translate to a slightly lower recurring margin compared to last year, but overall recurring EBITDA has grown. Annually, if you look at the numbers again compared to last year, as we saw the momentum through the 4 quarters of the year, you can see very strong growth across all 3 businesses. And if you see the trend of recurring EBITDA margins from the lows that we saw, it sort of come back to the levels that we saw. And of course, with the trend that we are seeing, the margins will continue to be at these levels or improve. I already spoke of the 4Q numbers. So you can see based on an index, you can see the trend of volumes in both soft drinks as well as confectionery, and the margins trending in that right direction. Looking at our retail business, a very strong growth in same-store sales in Q4, with a 16% growth in same-store sales, driven again mainly by footfall. In fact, this time footfall has been higher at 19%, with a decline of ABV at about 2.4%, which is why same-store sales is lower than the footfall growth. Very strong growth in recurring EBITDA from 2.1 billion to 3 billion, and recurring margins again have shown strong growth. On a quarter-to-quarter basis, it's a very strong growth, but just to remind you that Q4 tends to be a stronger quarter in any case, because we do recognize at the year end proportional income and rebates that we get. But if you compare it even against the previous year Q4, you can see the strong sales growth as well as other initiatives across our businesses have helped us to grow margins quite significantly in the retail business. Annually, if you look at the numbers, again, strong growth both across same-store sales, driven mainly by footfall growth, and that's been the driver of the profitability really in this business. And if you look at the annual numbers, the recurring EBITDA margin at 7.9 is really sort of much higher than we've had it over the last 3-4 years. Again, this is just showing you how the EBITDA has grown over the years. Yes, we've had a benefit of the reduction in electricity costs. As Krishant said, there's a proposal to increase electricity costs, which sort of really take us back to the January levels based on what's proposed. So you can see we've shown the impact of the electricity costs. So even if the costs do go back to the January levels, whilst there will be a slight impact on margins, really the improvement in margins has been driven by many other factors and the benefit of scale as well. Just looking at the decomposition of our retail business, we have a ABV decline of 2.4, as I said, and that's coming mainly through a reduction in selling prices because of the deflation that we are seeing, where the inflation index in the country was also down by roughly 2%, but the weight of purchase or number of units in the basket have shown an increase in line with how we are seeing consumer sentiment. Moving on to our new energy vehicle business, new business we started last year. The market opened out in February, so with that we ordered and got the shipments coming in and started handing over units from April onwards. So from April onwards, we'll be recognizing revenue and profits in this business. Total orders that we've received to date exceeds 5,000 units, and these will of course get delivered and handed over the next couple of quarters. We expect that roughly maybe 30% of the units that we have in terms of the order book should get delivered in the first quarter, which will then translate to profit recognition. We received a shipment of 500 vehicles at the end of March and started handing that over, and then there have been subsequent shipments that we have received. The impact of this business based on the current momentum and the order book we have is expected to be quite material in the context of the group's profitability as well. In terms of our charging network, we've already established 10 charging stations across our outlet network, but others are also investing in the charging network, and with that will augment our own expansion as well. Moving on to leisure, we've seen overall arrivals improving year on year in Sri Lanka, if you look at it compared with the last year as well, and we can go through this when we go through the Q&A. The momentum still looks very good, and the off-season as well, based on the forward bookings, is quite encouraging. Similarly, if you look at the Maldives, the numbers have been again stronger than we saw in 2024 as well. So if you look at our KPIs for the quarter, in Colombo, we've seen the occupancy improve. ARRs have declined. We have seen, as you know, a significant increase in the inventory in Colombo, not just with Cinnamon Life opening with 680 rooms, but some other properties coming on stream as well. So as a result, ARRs have softened a little bit in the city, but what's encouraging is that the number of tourists coming in to Sri Lanka as well as the numbers coming into the city have increased, and that's encouraging, and that you can see that with the occupancy numbers. So overall, the impact on RevPAR has been still positive, and that's translated to a better EBITDA margin. In Sri Lanka, occupancies have been by and large in line with last year, but a strong increase in ARRs over last year, and that has helped a strong growth in EBITDA margins. For the quarter, we saw Maldives being by and large flat in dollar terms, and EBITDA margins also being somewhat flat. If you look at the year, I won't go through the details here, but generally better than last year, other than in the Maldives where it was marginally lower than what we saw in the last year. Just to remind you though, as we spoke through in the quarters before, the Colombo hotels did witness a one-off cost on right-sizing the operations at Cinnamon Grand. So we did have a VRS cost there, as well as our Maldivian business did have again an impact of a large one-off debt provision because of one of the European tour operators filed for insolvency. So those were two impacts that we did have that are one-off, which affected the performance of leisure. The City of Dreams property, as you all know, we've opened the property. I won't go through the details, but as we went through the initial slides, the impact of the depreciation and interest, which we went through already, is significant. But as operations ramp up, we're very confident that these will get offset, and particularly with the casino also opening and the rest of the elements of the property opening, with the mall gradually opening in August as well as Nua, we are quite confident that the property will ramp up. These are just some images of restaurants and the spaces that we have. In terms of our property business itself, sales momentum itself is encouraging. The leads are more encouraging. The conversion to sales is also gradual, but we've seen a pickup. So if you look at Cinnamon Life, we've sold 294 units. So we are almost at 70% in terms of units sold. If you look at Trizen, we've sold 737 units of the 890 odd that we have. So that's about 83% that we have sold. And we are recognizing revenue as we hand over and sell the remaining units, which will be the case with Cinnamon Life as well. With Viman as well, we launched now phase 3 because as you can see, phase 1 and 2 are also almost sort of fully sold. So the momentum has been very encouraging, which where the team then launched phase 3 as well. So all this has meant that we've seen good translation to revenue recognition and profitability in the business. As I mentioned, last year we did have a loss of about 639 million. So even if you exclude that, the EBITDA would have been flat. But against that, we've seen a growth in EBITDA, and that trend will continue as we continue to hand over and sell more units, which will be the case in this year. And finally, on our financial services business, again with our insurance business, we had a strong growth in GWP with a 17% growth for the quarter. Profit growth was slightly muted. We did have some investment in our distribution costs, our agency and so on. As how it works in insurance is when you have the upfront costs and you expense that, for the profit recognition and the sales will translate in the coming quarters. So that's something that we will see that benefit of the expansion coming through in terms of the P&L impact. If you look at the profitability and performance of the bank, again we saw loan growth being quite strong at 15%, reflective of the pickup in private sector credit growth. NIMs, with the interest rate environment showing a decline, we've seen NIMs coming off slightly, but net we've seen the bank showing healthy growth in profits, as well as stage 3 net stage 3 loans have also come off from around 2.1% to 1.5%, which is quite healthy. So overall, we've seen a good translation to profit in financial services as well. So that brings us to the end of the presentation. Just to remind you, if you have any questions, please enter it at the bottom of your screens at the Q&A tab, and we will look to address all the questions that we have. Krishan, I touched on the leisure business and Maldives. We've seen a flat performance for the year by and large. Yes. Just in terms of outlook, is there anything we could elaborate on?
Yeah, just to elaborate, the last summer was quite weak. The off-season of 24-25 was quite weak in the Maldives, where we saw a lot of price competition in the segment in which we operate. The outlook for the next couple of months, which is the off-season, this new financial year is stronger. So in that context, given that winter bookings are also looking very good, we expect that for the full year, the Maldives will do better as opposed to a slightly muted performance, mainly because of not so satisfactory off-season in the last financial year.
Thank you. There's a question on the occupancy levels we expect in the mall when it opens. Yeah. If we can shed some light on that.
I can't give exact figures, but we expect it to ramp up gradually. We will open parts of the mall in August with the opening of the casino. There is access to the casino from the 7th floor of the mall, and occupancy on that floor we expect to be nearly 100% around the time that we open the casino. The other floors will get occupied. We already have bookings for the other floors, including the cinema space. So we expect the rest of the mall to get occupied over the following months.
Thanks, Krishan. Couple of questions staying with on leisure, Krishan. On the Cinnamon Discovery Program, any updates we can give on the current status, as well as the future outlook for AHPL and refurbishment plans, which I think we've spoken of in the quarters before, as well as in terms of the JKH portfolio now that life is operational.
The Cinnamon Discovery, it's too early to really give any indications of the traction in terms of numbers and volumes. It has been implemented, so a bit early to comment on how that is doing. On AHPL, as we have said before, we will watch how the city occupancy develops over the next couple of years. Right now, we have seen some pressure on room rates and occupancy just because there is a number of new rooms that have come into operation in the city, not just Cinnamon Life, but number of other new hotels. But at the same time, we expect demand visitation to the city to grow. I mean, we've lost 4 to 5 years because of what happened in 2019, then COVID, then the economic crisis. You know, if we had not had those 5 years of external shocks, we would have been at a much higher level of visitation to the country and to the city, if you look at the base of 2018. So based on that, we expect visitation to grow, and we will look at decisions like refurbishing the 2 properties only once we see that traction.
Thank you. There are a couple of questions which I'll try to answer on plans to expand the store network. As I covered it during the presentation, we're looking at maybe 10 to 15 outlets. That of course depends on land availability. We are quite stringent in our formats that we sort of stick to the same format, so we have to find conforming land so that we can build conforming supermarkets. And the timeline would be that, and of course depending on the outlook, like we've said before, we believe that the sort of density and the penetration of modern trade in the country is at still a nascent stage, and therefore it supports the fact that we can keep growing over the years. So that's something we expect to see over the years. There's a question on the incremental costs at Cinnamon Life once the new phases kick off. I think, the run rate that we are seeing in terms of our costs are not going to materially change. Yes, once NUA opens, because that is managed by Melco, but it's really, the asset is ours, so the payroll, the staffing, all will be on our payroll, but that sort of part of that has ramped up anyway. So there are no significant new elements that will come in. So really it's the run rate that we will see. And of course, the other side of it, like I mentioned, is the revenue generating capability, which will continue to increase over the next coming quarters. There's a question on JKH's exposure to the Indian economy and the Indian consumer and tourist. So if I take that, I think there are a couple of different touch points that we have. So if you look at leisure itself, the Indian arrivals it's the #1 source market into the country and one of the largest opportunities in terms of growing our leisure footprint into the country. As we've said before, we are 1.5 hours to 2 hours flight time from a lot of the key Indian cities, particularly in the sort of south. And with Indian outbound travel growing quite significantly and expected to grow with the pace of growth in the economy, it's something that we can capitalize a lot more on and we stand to benefit. So that's from a tourism perspective. If you look at transportation and logistics, again, our port, we have about 85% volume being transshipment and around 70 to 75% of that is Indian cargo. So really it's serving the Indian market, and that again is very much linked to India's economic growth and trade volumes. As we've said before, this is a very smaller part of it, but our beverages business tied up with Reliance a couple of quarters ago. So we are trying to sort of get a foothold in that market as well, but naturally that will be slower progress and be a sort of longer road into the market, assuming that the sort of flavors and the palates of the Indian consumer align with our products as well. But overall, if you look at it, it's really more the play that we see from tourism, transportation and logistics. And of course, there are other areas, but those are the main areas that we see. There's a question, Krishan, on the Finlay's land project or the Vauxhall, whether there are any plans around that and any color we can give on timing.
No specific timelines. We have done some preparatory work on that land. Given the success of the Trizen project, it is likely to be our next metropolitan, what we call the metropolitan project in the city. We've of course launched Viman, which has gone off well, and we will have more suburban projects. But the next development in the Colombo city, in the metropolitan segment, will be Vauxhall, the Vauxhall Street land, but there isn't a specific timeline I can give at this point.
Thanks, Krishan. There's a question on the current occupancy rate at City of Dreams.
Yeah, at City, occupancies have been ramping up. We are operating 687 rooms. So occupancy in the month of May, we expect will be around 25%. While that may seem like a low figure, in absolute terms, that's about 150 rooms a day. So it is a gradual ramp up over the last, since we opened for business in October.
There are a couple of questions on the consumer foods retail business, so maybe I'll try and address those as much as I can. There's a question on the improvement in consumer foods margins and whether we expect that to plateau. As we said, even in the previous quarter, we are having some slightly higher A&P costs, distribution costs, which is a conscious part of the strategy. And overall, with volume growth, we should see margins improving, but I mean, at the levels of margins that we're seeing now, we are not going to see a significant improvement. And of course, it will also depend on us investing in capacity and capability as well. So overall, margins will be maybe at these levels with possibly a slight improvement, but we could see improvement gradually after that over the next couple of years. There's a question on the reasons behind the decline in in-pass product volumes. Apologies if I wasn't clear on this. I think it's not that we've seen a decline in volumes. It's that it's grown, it's just that the composition or the proportions have changed because bulk in that particular quarter grew at a faster pace than impulse grew. So both grew, it's just that the relative contribution is lower, and that's why the mix is different, and then that just affects the margins. But in end of the day, in absolute terms, it's net still a positive that's come through. There's a question on the decline in ABV in the supermarket business, and despite the consumer businesses showing strong increases. So really this is a function of ABV, as we've said, is a function of the retail selling price, which is really directly linked to inflation. And as we've seen in the country, we've seen a deflationary environment, particularly in the second half of the year, and that would translate to sort of basket as well. So if you look at it, ABV has been marginally down or flat because the RSP or selling prices have been negative, but that's been offset to some extent by the increase in the weight of purchase, which is the number of units, again reflective of better consumer sentiment and demand. Sometimes when you look at this, you also need to look at the frequency of purchase. So it's, for instance, if someone bought 10 units in a basket, but they came only once a week, now because of some of our fresh initiatives and other things that we've done, people may come more frequently to the store, but that may mean that you buy 5 items or 6 items in 2 visits per week. So the number of average items in a basket might be lower, but in reality, the total number of units you're buying in a basket is greater. So that's why you may see the weight of purchase or number of units not necessarily showing growth. But if you look at footfall, which is a function of how many people have come into store and the frequency of the visits, that's showing a strong growth as you saw. So that's really the driver of sales, and it's really positive from both perspectives. There's a question on the effective tax rate of the group. So in our annual report as well, we had disclosed and we've seen a higher tax rate. But really, it's just the fact that, as we've explained in the report, if you look at the numbers that I showed you earlier, we have a headline profit number, PBT, of around 14 billion and a tax of around 8 billion, very roughly, which if you look at an effective tax rate there, it's very high. But that's because you have operational losses at City of Dreams, where because it's a tax-exempt company, you don't have any deferred tax impact. So really, if you look at it on a more normalized basis and look at the profit before tax X of City of Dreams, then you're looking at about a 20-21 billion profit before tax, which then normalizes really our effective tax rate. So there's nothing unusual going on there, and there are no sort of one-off impacts on tax or anything. It's just the composition of taxable businesses versus another business that's making losses. We sort of covered this, Krishan, but maybe if I ask you to talk about the recent tax increases in the Maldives, the shift in tourist preferences from resorts to guest houses, anything that KHL has in terms of strategic plan to manage this.
The shift that the increase in taxes was some time back, and the concern now is with the fragile position that the economy is in, how the government will deal with that in the Maldives, and whether that would translate to higher taxes going forward. We don't expect that to be material because they've already adjusted taxes, and we don't expect that, given how critical investment into the tourism industry is for that economy, that they would make material changes. In terms of the shift to the guest houses, there was that trend in the last 2 years, but the supply of guest houses now in the inhabited islands seems to have peaked. So we don't see a big new supply coming in, and with the growth in arrivals, we expect that trend to get better.
Thanks. There's a question on Viman. Just to clarify that Viman is not accounted for as a joint venture. We own the business fully, so that will be a normal recognition on revenue and the full recognition there. There's a question on BYD, Krishan, that they've undertaken several price revisions in China.
Yeah.
And I think there was a press release as well on this, but whether these prices would be reflected in Sri Lanka.
No, we had the general manager for Asia of BYD in town, and he is already quoted today in some news releases that is a phenomenon they see in the month of June in China, which is like a shopping month, and you see these kinds of price cuts that is unique for China. It will not have an impact on export prices of BYD vehicles and will not have an impact on prices in Sri Lanka.
There's a question, this might be a little more long term, but the future plans for JKCG Auto and whether there's an opportunity to set up an assembly.
It's too early to say. We'll watch how the business progresses. It will depend on the kind of volumes we are likely to see, sustainable volumes we are likely to see in Sri Lanka, and possibly any opportunity to export BYD vehicles in the region. But it's too early to really say anything specific.
Any comments, Krishan, on the new supply from star-rated resorts that we are seeing maybe in the next 12 to 24 months?
In Sri Lanka, there isn't anything in the pipeline. In Colombo, the only new addition will be the old Garadari, which is now going to be a Radisson hotel that is under refurbishment. That will bring in about 350 rooms to the city inventory, and that is expected to be completed towards the end of calendar year 2026. That is the only addition to the current supply.
Staying on leisure, is there an insight on the mix of tourists by origin in both local and Maldivian resorts? Do we see more of an inflow from Asian countries? We spoke of this, of course, with India being the number one source market, but
to comment, you're continuing to see that trend where Asian arrivals as a proportion are growing both to Sri Lanka and Maldives. In the Maldives, we have seen the Chinese, while India has grown throughout, even during COVID and after, there has been a sharp growth from India into the Maldives. We've also seen the China numbers returning to pre-COVID levels. But that Chinese numbers returning to pre-COVID, you haven't seen in all other destinations. And in Sri Lanka, arrivals from China are still about half what they were prior to COVID. In Sri Lanka, you're seeing a very strong recovery, or actually growth, in Indian arrivals. And this year should be the highest number. Calendar year 2025 should see the highest number of Indian arrivals to Sri Lanka, and that trend even in the month of May, if you look at the numbers up to the 25th of May, about 34% of arrivals to Sri Lanka are from India. So that's not surprising, as well as Gihan said, with outbound travel from India likely to grow very strongly over the next upcoming years with the kind of economic growth you're seeing in India, that they are coming into a neighboring country like Sri Lanka in a big way. It's only the beginning, and we are not surprised that India is growing so strongly.
There's a question, Krishan, on the current handling capacity of ECT, and of course, once completed, the total capacity will be around 3.2 million TUs anyway. And the current capacity,
I think about 400 meters is operational out of a full length of about 1.2 kilometers. And the current capacity is about 800,000 TU from our understanding.
There are a couple of questions, maybe I'll try and take these, on the expected impact on the electricity tariffs. So as we've said before, the type of increase takes us back to where we were in around January. So we saw roughly a 20% decrease in the tariffs in January, and the proposed increase is around 18%. So it takes us back to those levels. And as you saw when I spoke through the supermarket numbers, there is naturally an impact, but it's not as material. And like I said, it just takes us back to those levels, because net, if you look at it compared to 1 year ago, the electricity tariffs would still be a lot lower than we saw because of the multiple downward revisions. There's a question on elaborating on the breakup on bulk versus impulse in terms of revenue and volumes and the breakdown. I think we've given a split between the revenue in our disclosures. We are unable to get into a lot further detail on that. And also the question is why we have a relatively lower ABV compared to our peers. So I'm really unable to comment directly on that. But like I said, it's also ABV is a function of frequency. So it also depends on how consumer behavior might be. So I'm not sure you can necessarily compare it across one peer to the other. But we can look at it in terms of our own momentum because it's the behaviors would be more comparable. So the frequency of shopping also does impact ABV, like I mentioned earlier. There's a question on the reliance, the impact on our financials. As we've said before, it's not material in the context of our current performance. It gives us a foothold or an ability to get into the Indian market, and if things grow, it can become somewhat meaningful, but that's more of a medium to long-term play for us. But right now, it's not something very significant. There's a question on the benefit of ships being directed to Colombo because of the geopolitical tensions in this region. So yes, there are some impacts that we see overall in terms of trade, where Colombo tends to be a port that can be called on. So now particularly with Colombo having more capacity, because the constraint that Colombo had over the last couple of quarters was the inadequate deep water capacity. So now with WCT coming on stream with deep water capacity, I think Colombo can grow volumes, which would be, supply-led growth. There's a question, Krishan, on JKH being asset heavy with a lot of vacant properties. Why are we not looking to strip that and settle debt and bring down debt? Of course, we have seen debt levels coming down and being comfortable, but any comment that we can?
I think the material properties are in the city. It's the 2 city hotels and the Vauxhall development. As the premier property development company in the city, we expect the urbanization to continue. We expect the demand for apartments to continue to grow. And we think there's an opportunity to get more out of the Vauxhall Street land by developing it as opposed to selling it. And if you look at all the external shocks of the last few years, whether there is really a buyer for that extent of land is also not clear. But we are positive on the outlook for apartments, given the low level of urbanization at the moment and the low level of vertical living. So Vauxhall, as I said, is likely to be our next big development. And we think we can get more out of that than selling the land. On the 2 city hotels, it's really, as I mentioned, it depends on the traction we see on visitation to the city. But that also, we were just talking about booming outbound tourism from India, which will continue for many, many more years. So in that context, should we be refurbishing those properties? We'll watch the traction and make some decisions on those properties.
There's a question about selling some of our stakes to settle debt again. So I think in terms of our debt levels, as we spoke, we have a net debt to EBITDA of 2.5 times, net debt to equity of around under 30%. So our debt levels are manageable and quite comfortable in that sense. And there's no urgency for us really to do so. And of course, it depends on the returns we are getting from some of the stakes that we have. And we will continue to monitor, but we don't see a need to sort of do anything significant like that. In terms of the Vizhinjam port posing a competitive threat in relation to transshipment from India, Krishan, is there anything we can?
Yeah, I think Vizhinjam will be a competition. Of course, it is not, the volume, total capacity of the Colombo port with the West Terminal and the small capacity at East Terminal is about 11 million TEU a year. Vizhinjam currently is only 1 million TEU. I believe it can be expanded to about 3 to 4 million TEU. But in the context of the kind of demand that India is likely to see over the upcoming years for port capacity, container volumes in and out of India are growing substantially annually. While Vizhinjam is competition, we believe there will be enough demand for Colombo, for the additional capacity in Colombo, and that is a trend we are seeing as of now, because there seems to be a strong demand for terminal capacity in Colombo.
There's a question on the finance income decline. So we saw interest rates coming down as I spoke through the presentation, so significant decline in rupee interest rates. The translation of our dollar loans as well, because with the appreciation of the rupee impact of the finance costs on the dollar loans as well has come down. And so those are the primary impacts that we're seeing in terms of finance income, expense. We are almost out of time, or we are. I think I'll take one last question. I think we've covered most of the questions that you all have posed. There's a question on the dividend paid has fallen around 80% since COVID. The main reason behind this is the increase in debt and finance cost. Any plans to boost the dividend back to previous levels? Yeah,
I mean, of course, it's a priority for us to increase the dividend. We have just completed and operationalized two very large investments, City of Dreams, Sri Lanka, and the West Terminal. And that is the reason for the debt levels to grow over the last 3 or 4 years, in addition to the disruption to our normal operations because of COVID and the economic crisis. So as we operationalize these projects, and it has a positive impact on EBITDA, and as the economy also recovers and we see a better performance from our other businesses, we expect that we will increase dividends in the coming years. We don't normally give a guidance on dividends, and I can't be specific, but given that the decline has been due to what I mentioned, and given that we are likely to see the operations delivering better EBITDA from the two big investments and the improving environment, the dividend is likely to increase going forward.
Thank you, Krishan. That brings us to a close. We've addressed all, if not most, of the questions. Thank you. That was a very engaging session, and we did run through it fairly fast given the number of questions that we had to respond to. Thank you very much for your participation and for joining us for today's webinar. The link for this webinar will be available on our website in a couple of hours for you to follow, and the transcript of this webinar will also be posted a couple of days subsequently. Thank you very much once again for your participation.
Thank you.
Have a good